Well, good day, everybody, and thank you for joining us for our quarterly update on REIT performance. This is for the second quarter 2026, of course. My name is Mike Consol. I'm editor of Real Assets Advisor magazine, one of six titles published by Institutional Real Estate Incorporated, which is co-producing this webinar along with NAREIT, the National Association of Real Estate Investment Trusts. NAREIT is represented, as always, by John Worth. He is Executive Vice President of Research and Investor Outreach for the organization. Also joining the discussion is our guest, Brian Jones, Managing Director at Neuberger, formerly known as Neuberger Berman. Now, audience members, those of you who have been here before, you know, we invite your questions. We'd like to get them in writing. No need to attach your name. It'd be great if you can give us a first name, but if that's an issue, we don't really need a name, but we'd love to get your questions. As we always do, we'll integrate them into our discussion. You should also know that a recording of this webinar will be sent to all who registered, and the webinar will be published on both the IREI and Real Assets Advisor websites. By the way, the next webinar will be October 6th. So let's go ahead and get focused on that a little bit ahead of time. Look for the publicity on it. You don't want to miss it. It's a chance to hold John Worth and Brian Jones accountable for their analysis during this webinar. Great opportunity for all of you. Okay, having put you two gentlemen on the griddle, John Worth and Brian Jones, welcome to the both of you.
Thanks, Mike. Great to be doing another quarter. I'm a little distressed that you're reminding people they could go back and look at the prior quarter and hold me to account, but Brian will get it right, so we'll depend on him.
Always like to keep a little pressure on.
Yeah,
So, John,
great.
just to set the table as we always do. Let's go ahead and begin by you giving us a rundown of how REITs performed during the quarter and during second quarter 2026. What do the numbers say?
Yeah, happy to. And as you can see, Brian and I are all smiles. It was a very good quarter. Second quarter was a very good quarter for REITs. As you can see, up 10. The FTSE Nareit All Equity REIT Index was up 10.7% for the quarter, following 3.8% in the first quarter. And so this was so to date, on a year-to-date basis, we ended the quarter up nearly 15%. The beginning of July has been seeing a continuation of this performance through yesterday. REITs were up more than 16% on a year-to-date basis. And as we'll talk about, I think importantly, outperforming broader equity indices by over 500 basis points for the first time in a couple of years. And the last time we talked, we were in the midst of trying to understand what the impacts of the conflict in Iran were going to be. I think we have a better sense, at least as we stand today, we have a sense of where we are. And the story for REITs, and here I'm showing you a graph that shows you all equity REIT total returns for the year, with some key dates versus the Russell 1000 representing broader equities. And as you can see, at the start of the conflict, beginning of March, we saw a downturn in both REIT shares as well as broader equities. And so for the month of March, REITs were down about 6%. But starting just before the ceasefires was official, we started to see a meaningful recovery. And subsequent to that, we saw really quite a strong recovery. So we ended, as we get to the end of the second quarter, REITs are quite a bit ahead of where they were even pre-conflict, and maintaining that dispersion versus broader equities. And I think this is quite important because last year we had a similar turbulence in financial markets with Liberation Day trade disputes. And in that case, REITs came into Liberation Day, leading equities, having a strong start to the year, but really went sideways after that. So this year we've seen REIT returns being much more resilient. And then just talking a little bit about some of the property sectors, here you could see on the right-hand side of the screen, year-to-date returns, on the left-hand side of the screen, 2025 total returns, just for comparison. And as we can see, we've seen lodging it really rebound this year. Best performing properties sector, followed by specialty, and then data centers, which had been the worst performing property sector last year, ending the year down more than 14%. I think seeing some of those fundamentals coming through today, up more than 33%. Self-storage, also an area where we're seeing, improved supply demand, and a recovery for self-storage. Healthcare, best performing property sector last year, continuing that strong performance this year. And then retail, sort of again rebounding from a weak 2025 and 2024. We're seeing retail up almost 20%, 20%. And and then probably worth noting, office up 12.4%, a little bit weaker than the broader index, but had a very strong Q2, up more than 30% in Q2, after having a really weak Q1 to recover strongly in Q2. Lodging resorts also had a very strong Q2. At the bottom of the table, we see gaming and telecommunications both, sort of lagging the index for the year, and residential and industrial lagging the index, but positive returns. So with that, lots to discuss as always, and excited to get into it.
Yeah, lodging and hotels and resorts were left for dead, really, during COVID, and here they come roaring back. That is good to see. Brian, John alluded to this, but REITs outperforming the indexes, the equities indexes. They've outperformed the S&P 500. My understanding is by roughly 500 basis points year to date. What about REIT performance relative to equities, or any other observations you might have from the statistics that John just shared?
Yes, so I think it is interesting that REITs have produced strong 15% total return year to date. It has been quite a few years since REITs have outperformed the broader market as investors have been focused on AI and growth themes within the market. The relative the income and more modest growth trends of REITs were sort of taking a back seat to the growthier areas of the market. Now, today, we see investors looking for themes outside of the AI-driven sectors. We've also seen small caps and value indices appreciate this year. So that gives me a sense that there could be a shift in the leadership dynamic, which would play well into more value-related sectors, sectors that offer current yield and income as part of their investment offering. And so I think there's a good chance that the performance we've seen from REITs can continue. The other factor I think that's driving it is that the cash flow growth trends for REITs are quite solid and pretty strong in 2026. We expect about 6% FFO growth on average from REITs, and there's a good chance that we'll continue to see solid growth in the coming years because the supply-demand dynamic within real estate markets remains constructive. So we've seen most sectors see a decline in new development starts. So they've either declined or sit at a very low level, with the notable exception of data centers, where there is a lot of development activity. But if you look at most other sectors, the level of new construction is significantly down from peak levels, and tenant demand is generally stable to improving. So as you see a recovery from a number of years of relative underperformance, strong underlying operating fundamentals, and valuations that we would describe as attractive relative to either private real estate values reflected in discounts to net asset value for most REITs, or relative to the broader equity markets if you look at the cash flow multiples that REITs trade at relative to the broader market. So if you stack all these things together, I think you could make the case that REITs may be positioned for a period of strong relative returns, and the half of this year may just be the beginning of that trend. One thing maybe to counterbalance that enthusiasm is that the broader market is growing earnings at a faster pace than REITs are growing currently. So I think the S&P 500 or the Russell 2000 look to generate double-digit earnings growth in 2026. So REITs are still a fair way behind that level of growth, but still solid growth and attractive valuations, and the supply demand dynamics that I mentioned should lead to the potential for continued solid returns for REITs.
Thank you, Brian. So, John, we got a question from the audience. This is really for both of you. John, why don't you lead off? It's from Philip, who says, going forward, do you think the commercial office sector will end this year higher than it currently stands? So much going on in that sector. We've seen some better performance. We've seen these conversions to residential and so on. But there's some inveterate office investors, John. What do they have to look forward to here?
Yeah, I mean, I think the fundamentals in the office space are definitely improving. And here I'm talking in particular about the high quality, centrally located kind of office that REITs tend to own. That portion of the market, I think the underlying fundamentals are quite good. Even I'm sitting in Washington, D.C., tough office market in Washington, D.C., but at the same time, we're seeing starts of new office construction because the demand, fully occupied, by the way, fully leased up, because the demand for the high quality, well amenitized, well located office is quite strong. The demand for sort of lower quality office still remains very, very sluggish. So I could see, and in particular, when we look at this year, the office REITs really got off to a bad start in the first quarter, where essentially they got caught in a little bit of an AI trade, as we're starting to see people concerned about the future of work in a way. One way to express that because of AI, one way to express that concern was really this sort of second derivative. Well, if there's no white collar workers, I guess that means they're not going to need to sit anywhere. I think that and so REITs traded down very significantly on that, despite pretty good operating performance. I think that fever passed in a way. It may, obviously no telling if it can come back, but the underlying, and I think we're starting to see stock returns that are more in accord with the underlying fundamentals of the REIT offices, which have continued to improve.
Yeah.
And
Brian, I would agree with a lot of what John just said there. I mean, I think the key thing to consider with REITs and office is that REITs do over-index to the highest quality Class A assets in most markets, and they also have healthy exposures to some of the best office markets in the U.S. right now. So if you think about New York City, Boston, and then increasingly the San Francisco Bay Area, those are markets that have healthy REIT exposures, and they're amongst the strongest markets in terms of net absorption and occupancy trends and rental rate trends. One of the things I think that has influenced the volatility within office REITs is that they tend to be an underweight for a lot of REIT dedicated investors, and there's also significant short interest from hedge funds within the office sector. And so that can lead to sharper short-term movements, both up and down for office REITs. So, I would think that, the returns for office REITs will probably continue to be somewhat volatile as we move forward. The positive markets that I've mentioned, um, helping to strengthen the outlook. But even with better leasing trends, there are still some questions as to how the office REITs and how quickly they'll translate that into actual earnings and cash flow growth, because there's still significant TI packages, free rents in a lot of markets. So how the increased leasing activity translates into underlying earnings growth is a question that the office REITs will have to answer in the coming quarters. But I think it is better than it has been in recent years, as office REITs have struggled with the work from home dynamic coming out of the COVID pandemic, and now the AI driven fears. I think that it's hard to disprove that AI will have an intermediate term impact on office demand. So I think that headwind will remain, kind of flow in and out of the office REIT sector over the coming years. But I think it is nice that we can, as investors, we can target some of the more favored office markets in the U.S. Within different REIT portfolios. So you can be targeted and strategic in terms of which office REITs you choose to have exposure to at any point in time.
Well, a lot of provisos there, Brian. So let's oversimplify this. Is office a buy, sell, or a hold in your estimation?
Yeah, I think I would put it in the hold category, in terms of you want to be kind of laser focused on the exposures to different classes of office. So you want to stay focused on higher quality A assets, and you want to stay focused on the markets that are showing positive inflection in terms of underlying demand. So I would say it's a hold, with kind of interesting themes and interesting geographic opportunities to try and take advantage of.
So office is one of many components, obviously, of publicly traded REITs. What are you telling your clients at Neuberger regarding how and where they should invest in publicly traded REITs? What's the overall message there?
Yeah, so at Neuberger, Neuberger has a long history of investing in REITs. Our REIT dedicated team joined Neuberger in 2002. And so we've had a consistent dialogue with Neuberger's clients around opportunities to invest in REITs. And so, we have mutual funds, closed-end funds, institutional and high net worth separate accounts, all with exposure to REITs. So we've been pounding the drum a little harder this year as REIT performance has improved, and we think it's a good opportunity to allocate to this asset class. I think the thing that's been more interesting, and we've seen more opportunities at Neuberger, is to position REITs in multi-asset strategies here at Neuberger. So there are a number of portfolios that combine equities, fixed income, private assets, real assets in one portfolio, for clients. And we've had good traction in making the case that REITs, as a liquid real asset investment exposure deserve a place in those multi-asset strategies. And then, interestingly, we can also target different current yields within those strategies by blending REIT common shares, REIT preferreds, REIT corporate bonds to generate a current yield that a particular client or set of clients could be interested in. So I think it's making the case that REITs are attractive relative to broader equities, and then also making the longer term case that REITs merit an exposure and asset allocation, multi-asset strategies. And that second message, I think, has been resonating well with Neuberger, different teams at Neuberger, and our underlying client base.
Hmm. So, question from our audience. Lisa says, John, what is your outlook for healthcare REITs, particularly those with a focus on senior housing? We've seen senior housing very hot these days among investors, John. What about Lisa's question? What say you?
Yeah, I mean, as we saw earlier, healthcare was the best performing property sector in the REIT space last year, driven, in large part by senior housing focused REITs, sort of driving the train on those healthcare returns, and doing well this year, up 20%. And the perspective that we're seeing is that those demand tailwinds are not going away anytime soon, right? The demographic drivers are going to continue to remain strong. The 80 years plus portion of our population is kind of the fastest growing cohort. Baby boomers are continuing to age into that cohort. It's a population with significant financial resources, and is likely to continue to drive demand into that sector in a fairly predictable way, I would say. The real question mark, I think, in senior housing is how quickly do we see supply grow to meet this demand? And I would say that part of the supply demand imbalance that we're seeing right now was driven by COVID, right? We didn't see many starting in March 2020 in senior housing. Occupancy fell. It took a while for that sector to recover. Now that recovery has taken place. And so the question mark is going to be how quickly do we see supply come online? Some indicators that I've seen suggest that, the supply is not coming online as fast as you might expect. We've seen in different sectors, like if you think about self-storage a few years ago, had a couple of years of great returns, saw a huge wave of supply. Senior housing is going to be more difficult to site and locate and get built senior housing facilities in the places where demand is going to be. So all that gives me my sense is that we could see these strong returns in this sector for quite a while as supply catches up with that demand.
Yeah, I think that all makes sense. The one thing I would add is that in addition to the strong internal growth that the senior housing REITs are able to capture, they've also been very successful acquiring assets from third parties. And so that, internally driven growth through occupancy and rental rates, plus the ability to close attractive acquisitions, creates kind of a positive double-edged sword for the healthcare REITs. And interestingly enough, the initial yields for senior housing acquisitions are similar to other areas of real estate, even though senior housing probably has the best, if not amongst the best, growth characteristics over the next few years. So it's an interesting acquisition opportunity on top of the underlying growth dynamic that's occurring. And then the last piece I would just point to in terms of reasons we think the growth dynamic for senior housing will continue is that the REITs are becoming stronger in terms of their operational understanding of managing this asset class, and they've been able to push their operators to improve the underlying performance of assets, whether it's by pricing the asset appropriately, managing expenses appropriately. And so, there's kind of an operating efficiency story within senior housing as well. So all these positives come together to create an attractive dynamic. The multiples are higher than average REIT sectors, so some of this is appreciated by the market, but we think there's still a good runway for the senior housing healthcare REITs.
So, audience member Rose is asking that you give some more color on the hospitality REITs sector. She points out that lots of CMBS loans are coming due in the next 2 to 3 years. Is this the right entry point for acquisitions for REITs? How do you see pricing in this asset class play out over the next 18 months? John, you want to lead with that one?
Well, I think on in the hotel space, to me the strong performance this year has been very much connected to their strong operating performance, where in Q1 we saw year-on-year FFO growth of 10%, NOI growth was up 7%. We were seeing occupancy rates up. So I think part of that the stock performance is reflecting actual operating performance. So in terms of expansion, I think that what we'll see is that the lodging REITs tend to be pretty selective, at least at the higher end, in terms of what types of properties they want to add to the portfolio. So I think in terms of a CMBS sort of distress-driven strategy, it would very much matter what properties were in that portfolio and how it aligned with, especially at the higher end of the market. Most of the REITs are owning pretty premier, high quality type assets, which which I think is linked to some of their operating performance in, kind of a K-shaped economy themed play. So I think, it would very much depend on what is sitting in those CMBS portfolios and in terms of quality and operating performance.
Mm-hmm. Hey, Brian, I've got a Neuberger specific question to ask you. We're getting a lot of
Okay.
audience questions, so I'm going to ask you guys, maybe one of you answer. Jump in if you have something important to add. Maybe we'll speed things up a little. Kevin says the multi-sector REITs seem to diversify to the mean, so there's very little opportunity to gain alpha. Will Neuberger have any more REITs that will be more sector concentrated?
Yeah. Well, I think it's an interesting point you make about the apartment REITs in terms of how their portfolios have become somewhat more similar. Largely within the apartment sector, the main distinctions are REITs that operate on the two coasts, so on the West Coast and East Coast of the country, and then there are a number of REITs that operate in the Sun Belt and Texas markets. So the biggest call you can make in apartments right now is, do you prefer a coastal strategy relative to a Sun Belt strategy? But I think it is true that the apartment REITs, they're generally good operators of assets. They generally have strong balance sheets, so it becomes a little more challenging to make distinctions between the different apartment REITs. But I think that geographic distinction is the most significant one within the apartment sector. And then broadly speaking, as it relates to apartments, it's a sector that's I would say, bouncing along the bottom in terms of their fundamental trends. So we've we've come through a period where there was significant new construction of apartment assets. That's rolling over and beginning to decline, but there's still the lease up of recently delivered apartment developments that are pressuring the trends within the apartment sector. And so, really, a lot of the investment analysis we do is understanding which REITs are less exposed to that, we'll call it development hangover, and are positioned uh, to grow at a quicker pace. I think there within REITs and within residential, there are other subsectors. So there's single family rentals and manufactured housing. So if you want to, uh, you know, go for different exposures within residential, you can certainly allocate towards single family rentals and manufactured housing. And we think that those two sectors have somewhat stronger near-term fundamentals relative to traditional apartments. So one way for us to express our residential thoughts is by allocating to single family rentals and manufactured housing.
So, John, we have an anonymous audience member who's asking, do you have any projections on future long-term performance for the REIT sector, given where we stand today in terms of yields and starting valuation points?
Yeah, I mean, so long-term projections are obviously difficult. When we kind of look to history, right? Equity REITs have returned total return, plus minus 9 to 10% per year over the last 25 to 30 years. And I think that you might say that REITs set up in the near term to outperform a little bit. And the reason I say that is, one of the things we spend a lot of time focused on right now, and that we wrote about quite a bit in our mid-year outlook, is what we kind of call the dual divergence that REITs sort of came into 2026 with, where REIT valuations had lagged both equity valuations as well as private real estate valuations. And so one of the things you could do is sort of compare multiples between broader equities and REITs. And coming into 2026, we saw that we had a very wide divergence. And that divergence has started to close in 2026 as REITs have outperformed broader equities and multiples have expanded a bit. But we still have a ways to go. And then when we compare REITs and private real estate, we can see that the valuations there have really not converged. REITs moved dramatically back in 2022, priced in a higher interest rate environment. Cap rates rose pretty dramatically. On the private side, where we see appraisal-based valuations, and particularly Odyssey funds, where we can see the cap rates, we have really only seen what we kind of call a modest and measured increase in cap rates. So today, private cap rates, appraisal-based, are really sitting right on top of the 10-year Treasury, sometimes below, whereas REITs have a healthy spread to the 10-year Treasury. So as we see both of those markets converge, which they always do, I think that does create some opportunity for sort of near-term REIT outperformance in the next couple of years. But beyond that, I think, I would look to history to think about what those long-term growth rates are.
Mm-hmm. Brian Jones, here's a timely one for you. Victor, one of our audience members, says, how will the new congressional housing bill affect housing and urban development and housing in the REIT space? I don't know if you've had time to analyze that very much, but any initial thoughts?
Yes, I've looked at the bill that has passed, the Road to Housing Act, and the primary impacts would be on some of the residential sectors, and primarily the initial concern were some restrictions as it relates to institutional ownership and development of single family homes. And so the initial bill was restrictive in terms of uh, single family homeowning REITs, buying individual assets on the MLS, and also required them to divest assets that they developed over a number of years. Some of those provisions have since been removed from the bill and were not in the final bill that passed. So it's much more neutral to the single family rental REITs than the initial proposals. But the way these things tend to work is, the worst case scenario hit the valuations of the REITs, and then when it became less worse in its final form, the REITs didn't recover all of the downdraft that they had experienced. So we think that that has created some investment opportunities for the single family rental REITs. As it relates to manufactured housing, the bill um, opens up some additional opportunities to finance manufactured homes and lift some of the restrictions on the development of those communities. So I think it's probably a net positive for the manufactured housing sector. Overall, I think the thrust of the bill is to try to accelerate the development of residential housing in the U.S., given that we continue to be at a shortage of residential homes. How effective the bill is in ultimately stimulating additional development of residential is an open question, but I think that it's something that our country would benefit from in the long term and should generally be considered a neutral to a slight positive on average to most of the residential sectors.
Mm. John, here's a question you might want to say. Brian, why don't you take this one instead of me? But anonymous question: what is each of your views on international REITs versus U.S. REITs? First, for starters, John, does NAREIT represent strictly North American REITs, or do you have overseas membership as well?
We have some non-US members. The vast majority of our membership is US based, but we certainly think about the global, REITs and listed real estate on a global basis. We run the along with our partners EPRA in Europe, we run the FTSE EPRA NAREIT global indices. And so I would say the global this year has been a tough year for REITs outside the U.S. I showed you a chart at the beginning where I showed how U.S. REITs had really recovered since the downdraft at the beginning of the conflict in Iran. The same has not been true for Europe and Asia. While there have been some bright spots, those regions have really essentially flatlined since the beginning of the conflict, reflecting, I think, a number of things, but importantly, the degree to which the underlying economies are more energy import intensive versus the U.S. That said, I think the one of the great attributes of REITs is that this ability to put into your portfolio what might be missing. And in a lot of cases, that is the ability to use REITs to get global exposure in a US portfolio or in a non-US portfolio to get US exposure. So it's a really important part of the investment proposition. And the US has generally outperformed over the last 5-10 years, has generally outperformed non-US. But however, then we'll have years like last year where the US lagged both Europe and Asia, showing, so there is that ability to get diversification benefit, exposure to non-dollar denominated returns, as well as, different speed of growth of economies. So yeah, while we don't represent directly a large number of non-US REITs. We view the global proposition as very important and something we see, I would say of the investors we talk to institutionally, about half have US strategies and about half have global strategies.
Hmm. Brian, I don't know if you're a gambling man, but there's a question here as to the long-term future of gaming REITs, given the rise of, uh, this question mentions online gambling, but then there's also the prediction markets. There's a lot of opportunity if you want to let your money roll. There's a lot of opportunity there. So, what does that mean for the long-term future of the gaming REITs?
Yes, I think it's an interesting question. The gaming REITs, there are two large public gaming REITs, and so they have successfully acquired assets from the casino operators, and they are, land-based casinos, sometimes with attached hotels to them. I think the key thing we think about as it relates to online gaming and prediction markets is that the experience of gaming, whether it's going to a physical location, the dining, the interacting with other people, the camaraderie of a casino environment, um, is somewhat insulated from a threat of online gaming, just because the physical casino experience is somewhat unique. One of the things, we also think about is that a lot of the owners of the physical casinos are the same players that are involved in the online gaming casinos. And so, as much as their online business grows, that's part of the entire corporate entity. And so, the casinos would benefit from the credit enhancement that the online gaming revenues produce. Prediction markets, I think, are a little more unique because the tax implications of those scenarios have have been very contentious with the states, because gaming revenues are important to a lot of state budgets, and the way the prediction markets generally operate, they are able to avoid a lot of the state taxes. So there is some um, alignment of interest between the casino owners and operators and the states that regulate gaming and gambling, in terms of uh, regulating, taxing all types of gambling that occur. So it's somewhat of a complex situation, and we'll have to see how it plays out in the future. But thus far, the physical casinos haven't been overly negatively impacted by the growth of online gaming or prediction markets to date.
Hmm. Gotcha. So, John, how will land REIT, another audience question, how will land REITs perform this year? And do you consider land REITs to be a stable investment? John, I hear a lot about, industrial outdoor storage. Then you have data centers that need land. Has that changed the whole land equation? For instance, people banking land and then being able to turn around and say, hey, it's available for you for industrial outdoor storage, it's available for data centers or what have you. I don't know whether it's changed at all. I mean, I'm not trying to steal the core question being asked here. I'm just saying there may be some extenuating circumstances.
Yeah, well, I think there's a couple things going on. We definitely see REITs in different sectors that have land banks that they are, holding for future development in their portfolio. But, obviously, could also be assets that they sell at some point, and those could be quite important, especially in sectors where we're seeing it becoming more difficult to get land, to either acquire land or to get approvals to build on land, and we're seeing that across a number of different sectors. Having a land bank of pre-approved, well located opportunities for future development can create a lot of value. In terms of the specific, the land specific REITs, we have a couple of them. We have some farmland REITs, and that are really pretty small cap companies. And then we have some larger REITs that own land, but they're very different strategies. So we have one that holds essentially land leases below commercial buildings, and then we have another that owns land that is used in residential development. So they're really very, very different strategies that are hard to paint with a single brush. So I guess my advice would be you really need to look at each of the strategies independently, because it's hard to paint the whole sector with one brush right now.
Mm-hmm. Brian, Lisa from our audience has got a question for you. Should apartment REITs be considered lower risk and therefore require a lower dividend return than senior housing and healthcare REITs? If so, what should the spread be between the two? Kind of a technical question. I don't know if you have to work this out on paper for a little while for Brian.
Yeah, I think from two angles, apartment REITs have typically been considered lower risk than most other REIT sectors. One is the financing availability from the government mortgage agencies, Fannie and Freddie and Ginnie. And so that availability to finance apartments, even in environments where the debt capital markets may be somewhat disrupted, has generally led to lower cap rates for apartments relative to other sectors. And then the other benefit that they have is that apartments, along with probably industrial warehouses, are amongst the most liquid asset types within the REIT space. So it is easy to sell an apartment community because there's a large pool of potential buyers. So that financing availability and liquidity in the private market has tended to lead apartment REITs to trade at somewhat lower cap rates and somewhat lower dividend yields versus other REITs or particularly senior housing. From our perspective, senior housing is generating stronger growth than apartments at this point in time. So that that differential in initial yields should be tighter than it has been historically. So but apartments are significant, are tend to be a favored food group amongst real estate investors, and that leads to lower yields often.
Yeah. Now, Gino from our audience, John is asking about your slide and saying, is the diversified category a mix of all categories or a specific selection?
Yeah, that's a great question. Very common question. So diversified, which today only makes up about 3 to 4% of REIT market cap. These are REITs that do not fit into a pure play category of one of the other sectors. So typically they'll be blending. They'll have ownership that blends a couple of the other sectors. Uh, Today, when you look inside the diversified, sort of who's getting categorized in the diversified sector, you actually see a lot of net lease REITs. So, while their property types are diversified, because they may own, industrial, retail, some even potentially even some residential properties, the business model tends to be net lease business model. Not true across the board, but true in general within the diversified sector.
Okay, Benjamin from our audience, Brian says, what are your thoughts on the GNL acquisition of Modiv, MODIV, if I'm pronouncing that correctly. Is GNL a hold and wait and see?
Um, yeah, so GNL is actually, I believe, one of the REITs that falls into that diversified category.
Yeah.
And so they are.
Brian is a FTSE Nareit expert. That's an excellent job.
So they have a diversified pool of net lease assets. I think that they are working to kind of modify their business model to a degree, and so the acquisition of Motive, I think, pulls them into more of a direct real estate ownership model in addition to their traditional net lease model. So I think it's an interesting opportunity for GNL. They'll have to prove out that they can integrate this business that differs from their traditional business into their company effectively and explain to investors how the combined entity should produce better returns or better growth than their traditional net lease model. So I think it's an interesting opportunity because it will bring them into a business that kind of skirts, private real estate investing with being a REIT. And so time will tell kind of how successfully they can navigate that business shift. But we're certainly intrigued that they made this acquisition, and we're monitoring the situation.
It, one thing just to add, not specifically on the GNL Motive deal, but it is illustrative of one of the broader themes that we're seeing in REIT M&A over the last couple of years, where privatizations tend to get a lot of press and exposure, but if you actually look at deal value, most of the action has been in REIT to REIT transactions where the acquiring REIT is looking to grow their operating platform, grow their AUM, lower their cost of capital, and get bigger. And I think I put the GNL Motive deal very much in that bucket.
John, let's stick with you on this one. Another audience question. Is there too much hype in the data center REIT space and too little hype in the towers REIT space? Do you know what he means by
Well,
towers REIT space?
oh yeah, sure. So data centers versus cell
Cell
tower
towers. There
REITs.
we
Yeah,
go.
and I would say that the too much hype on data centers, I think, is a really open question because, as Brian mentioned, that's the one area in commercial real estate where we are seeing a tremendous amount of development. I do like to distinguish between what's going on in the REIT data center world and what's going on in the broader data center world, because I think that it's an important distinction, and you can sort of get a little carried away. It seems like every day you sort of open your news source of choice and you see another multi-billion-dollar data center development deal. Um, and and I think those are important, but it's important to keep in mind those are primarily hyperscale deals. These are very large, typically single tenant data centers that are going to be used by and large for AI training. And that is not really where the REIT data centers are today. Most of their current tenancy is actually traditional cloud-based. And I would say that in general, it's unlikely that they will ever be deep into the AI model training business, just given the location of their data centers, which tend to be near population hubs. I'm sure that they will, in time, be used for a lot of AI inference, essentially taking the trained models and serving end users, which will be additive to their demand. But in terms of some of where I think there might be what you might call sort of hype around data centers, I'd say that overall the REIT data centers are not front and center in that world. Although they are doing development, but it's development on top of a lot of stabilized fully occupied data centers delivering income today, as opposed to sort of speculative potential future clients. So that's kind of the data center piece. In terms of the telecom REITs, that has been an area where they have been sort of underperforming for the last couple of years, as they've really been essentially, I think, in a waiting game, you might say, for more mobile carrier demand to really be realized. And I think at the end of last year, there was a lot of hope that this would be the year where we would see the mobile carriers who lease their space on telecom towers to provide, your data, your mobile data, cell phone, 4 or 5G service, that we would see more build out in advanced 5G that would start adding to their underlying demand. But so far, that has been slow to come to fruition.
Yeah, no, I agree, and I think towers they've hit a few kind of tower specific challenges. The most recent being the launch of the SpaceX IPO. There are some concerns that SpaceX will want to launch a cellular service that will rely on their satellites to make the communication connections as opposed to cell towers. And we don't think that technology to go directly phone to satellite consistently exists today. So we think that risk is a little overplayed, but it's a factor in how people view the cell towers. And so you've just got to kind of navigate a few risk factors and figure out your comfort level with them. But they screen attractively valued relative to history or relative to assets with similar long-term growth trends.
We have just a few minutes left, and John, I thought I was going to be talking with you guys about the ceasefire in Iran. How's that going to affect REITs? Well, the ceasefire is dead, and we are back to lobbing missiles and other projectiles. So I'd like to hear from you and Brian, just with what's going on in the Strait of Hormuz. How big a factor is that in when you're analyzing REIT performance in various categories? Is this going to be a big factor, or is it, something has an effect, but not a big part of the overall calculation?
I think it's going to be a meaningful part of people's calculation. Last time we talked, we were in a little bit of a wait and see mode, with the idea that we'll have a pause and then maybe a formal ceasefire, and we'll see oil prices fall, and we'll see probably the 10-year Treasury start to come down. We sort of got half that equation, right? We saw oil prices did fall pretty dramatically over the last couple of months. The 10-year Treasury really did not revert, and so now we're seeing oil prices rise again. I think that it's very much a sort of dust off your notes from a couple months ago situation, where I do think if we have a continued period of high oil prices, that starts to impact how much disposable income households have. If you think about households using about 1,000 gallons of gas a year, $1 increase, that's $1,000 out of your disposable income. In a world of 60 to 70,000 median household income, that's a meaningful impact on disposable income and where that disposable income gets spent. Which can have an impact on the tenants of REIT properties. I think one of the nice things about real estate in a space like today, with this level of uncertainty, is there's a couple layers between the household and most REITs, obviously. So that you start worrying about those demand conditions if we have a situation that goes on for a long period of time. And I'll kick it over to Brian in a second. One thing I'll note is that in periods like today, where you see turbulence in spreads widening, 10-year Treasury moving around, this is one of the places where I think the REIT balance sheets, the low leverage, the today almost 6 year weighted average term to maturity, this is where that really pays off in terms of being able to have capital markets that are open, uh, financing costs that are not spiking because you have mostly fixed rate debt. So I think that there are, it's definitely something most people should be aware of. It's going to be challenging for commercial real estate broadly. REITs do have some advantages in that space, though.
Yeah, I mean, I agree with most of what's been said. I would just add that, you know, the both investors, consumers, and corporates have been dealing with some level of geopolitical uncertainty for quite some time, whether it was the tariffs last year, war this year, oil prices, inflation. There always seems to be something to worry about, but it feels almost that most investors and most corporates are considering this kind of just the operating environment of today. And so unless something directly impacts, their business, people are trying to corporations are trying to run their businesses, consumers are trying to live their lives. And so it's going to take a real meaningful shock, geopolitical shock to be to trigger, a sell-off or some sort of loss of risk appetite. So it's something I pay attention to, but I've been worried about these things for quite some time, and the real estate and equity markets seem to have endured so far.
Yeah, it's astounding the resilience of the U.S. economy, terror attacks and economic collapses. The resiliency, the agility is just amazing, and we just keep chugging along. And I think it has everything to do with being an open market system where we have thousands or millions of people on the ground making decisions that they know because they're close to the ground, they know what the right decisions to make are. Listen, I want to thank our audience members. A lot of questions here, great questions. Thank you for participating in that way. Thank you for showing up. And if I'm sorry that we didn't get to all those questions, but feel free to reach out to John Worth and Brian Jones offline. But our time is up. So John Worth of Nareit, Brian Jones of Neuberger, thank you for sharing your data and insights. And to our audience members, again, thank you for your attendance and participation. Again, October 6th is the next webinar. Look for that publicity on it. We hope to see you there. Until then, on behalf of IREI and Real Assets Advisor Magazine, this is Mike Consol wishing you all a good day and a great third quarter of 2026.